Okay, everyone, welcome. 7 p.m. in Toronto, Wednesday. Ronnie and I decided to create this series of webinars. We're living in very extraordinary times, tough times to say the least, unusual times, not easy times, and it's our duty, obligation to help out those who seeking for guidance, looking for some answers, and that's probably most of the population right now. Obviously, we do not know what's going to happen, how long the virus is going to be with us, but we want to provide everyone with some insights, some thoughts sharing process, some things that we discuss between ourselves, what we can do, what probably the best point of action these days is. So this is going to be a series of webinars that we plan on doing. Today is the first one. So it's the first one also for us to do webinar. And not just we're doing the webinar for the first time, we're also doing it in different rooms because of the social distancing. So I hope it will go without any technical glitches, but if anything, just let us know, just type us. We'll make sure it works well for all of us. Now, I went over the names of people registered. We did not advertise this webinar a lot. We just sent it to our list and a couple of Facebook groups. And to be honest, the response was overwhelming in a good way. We did not expect so many people to come and to want to learn this information. So we really appreciate that. It's a great number of people that are joining us, and guys, we're here to support. We're here together. So we're also here to hear from all of you. So we're in it together. So let's share the thoughts, and we'll get through that. There's no question about it. And so let's just start. So, okay, so this is the first slide. Obviously, the name of the webinar is Volatility and Opportunities in Real Estate During COVID-19. So we're going to have two parts of the presentation today. I'm going to do a little bit presentation, and then we'll switch to Ronnie. And in the end, it's going to be time for questions and answers. We'll see how it goes. We asked people to send the questions prior to webinar, but there were several. If there's time left and there's some questions that you've got, probably we'll see. We'll answer them. If not, we'll ask to submit questions for the next time, and we're going to cover those in the next webinar. So we know most of the people registered. As I mentioned, we did not advertise it too much to the external world. But when I look at the list of people registered for the webinar, there were several names I did not recognize. So just to give a couple words about us, we're not strangers. We're a CFP Group, which stands originally was Cash Flow and Properties, switched to Cash Flow and Projects. We were a Toronto-based real estate investment company. Combined between the two of us, we've got more than 25 years of real estate investing experience. But if you bring our development partners, we go way over 100 plus years of combined experience in real estate. So really, we're really proud of the team that we actually put together, and it's been a pleasure and blast working together for the past several years. We do real estate projects in Canada, in USA. If you're interested to see what we're doing, I put a link. So just if you're interested, just can go and see what the projects we do. Most of the projects are in the United States right now at the moment, but we've got some current projects in Canada as well. We've got more than 70 investment partners, and proud to say this amount is growing almost on a weekly basis. And what we do, we offer project sourcing, consulting, we do financial structuring of deals, as well as we do coaching and mentoring. And I'm going to talk a little bit more about that when I introduce Ronnie, but this is probably one of the areas most people need these days. We also created a community of real estate investors approximately almost 3 years ago. We call it Investors Inner Circle. It's Toronto-based. And the idea is that we come and share our knowledge, share the expertise, the experience of real estate, and we grow together. We opened that initially for students of what we call legacy. At the time it was Tigrant, but over the time the community expanded and more and people asked to join us. The community is closed; it's not open to public. People can join and be accepted in the community. There is a small process to do it. It's free of charge, and it just at the moment it's important to us to keep it on the smaller. So there's X amount of people we can help while doing the business, which takes most of our time. Okay, so I'm going to cover 3 topics today. And the first one is something called set of the sale. We had a March Investors Inner Circle community meeting on March 2nd, and it sounds and it looks today like it was ages ago. In fact, it was only 23 days ago. And when I was doing my presentation, the name of presentation was the best 10 advices I received from worldwide coaches or different coaches. This was actually my first slide that I presented. And boy, was this slide on the topic. I mean, how quickly things changed. So let's get into that. The name of the slide, as you can see, set of the sale. So the person you can see on your screen is Jim Rohn. He is widely known as a founder of business philosophy in the United States. Many people follow him, and to this day, they listen to the cassettes and the audio recordings of Jim Rohn. Fortunately, passed away several years ago, but his legacy stays. And one of the things I learned from him, and I learned many, but one of the things, and it completely changed my view on life and everything. So what I said, it's a principle of what we call set of the sail. What Jim said is that the same wind blows on us all, the wind of disaster, opportunity, and change. Therefore, it is not the blowing of the wind but the setting of the sails that would determine our direction in life. So what Jim means is that all of us, we've got the same opportunity. Okay, nothing changes. We all live under the same circumstances, under the same environment. I mean, the virus, as hard as it's been on us, it's devastating, but it also brings opportunity that people can take advantage of. So the question is, how ready are you going to be? So 23 days ago, when I presented this slide, I show an example of striking teachers in Ontario. Those of you who are in Ontario, you remember probably that people were on strike, and my message was that if something happens and something happens outside of your control, what are you going to do? And I was talking about teachers who could not go back to school. And then the COVID-19 was not a spread at that time. And look what happened now. And now many people just simply do not what are they going to do? The unemployment obviously is going to increase. So my message to you is the following. You're responsible for 100% of outcome. I mean, COVID-19 happened. We cannot change that. But what are you going to do about it? So this environment presents many opportunities, huge amount of opportunities we all can take advantage of. But you need to be ready for that. And it's obviously we're all in different stages of our lives, financially and otherwise. But look at where you are today, what you need to improve. I don't know, maybe you need to learn new investment strategy. Maybe you can prepare yourself to do deals when you're going to have funds. Maybe you need some coaching. So this is the best time. This is the hardest time to make those steps, but this is the best time because the window of opportunity is typically very small and short, and I'm going to cover that. So this is the best time to get ready for what's coming. Okay, so that's slide number 1. Slide number 2, or topic number 2, is understanding of the market cycles. And I felt that this is really, really important to bring at this point of time. And this is the cycle that's not going to change, never changed. What you can see, there's lots of smileys that cover the cycle of the market. So up until February, and I hope you can see my mouse, up until February 21st, we were right here where it says euphoria and complacency. Okay, the market went up, the Dow Jones and other indices reached the all-time high, and everyone was happy. Now, many people predicted recession, but we said, well, probably it will not happen this year because it's an election year in the United States, and normally the presidents try to do all they can just to either to be reelected or to leave with a good impression. So many people thought it would happen, but it would happen next year. And obviously, COVID-19 came, and then the crash was quick. Typically, the down market happens fast, so the next steps are anxiety, denial, and fear and panic. And normally, it could take some time, could take several months even. But in this case, because of COVID-19, it was so quick, we basically skipped the anxiety, denial, and fear, and we went straight into panic. Now, we're in a panic mode right now. Actually, things started to settle down a little bit, but we're way from recovery, and it will take time. So after panic, normally it's going to be anger. People are angry at different things, right? Things what they could control and things that they could not control. But after anger, there is depression, and then the beginning of recovery, what we call hope. So for you to understand, I want you to look up where it says point of maximum financial risk. So when you go to the, let's say, grocery store, and you hear the employees in, let's say, Longos talk about investing in stock market or buying pre-construction properties, probably is the best time to get out of the market if you're trying to time the market. And at a time of panic and anger and depression, this is the point of maximum financial opportunity. And this is exactly where we're at now. Okay, so we do this series of webinars just to prepare you to share. We were going to share some ideas of what we can do jointly to take advantage of this situation that eventually is going to be over. Eventually we'll come to the end. So I want to give you a couple of examples of stock market and real estate market. But before that, I want you to see those two graphs. So the last recession, the last point of panic or the depression happened on March 6th of 2009, exactly 11 years ago. You can see the Dow Jones was at 6,600 points. That was the low that went from the highs of 2007. It took approximately 1 year plus to reach that point. And it was also quick, but not as quick as it was today. If you look at the graph on the right, look at where we're now. So basically, the top arrow, the red one, you can see, that was the 21st of February of just a month ago. And the Dow Jones was at 28,992. I think at some point of time it reached 29,000 points. And in between, you can see there was no recession. We had several corrections in the market, but there was no recession. Typically, the cycle is between 5 to 7 years. But for 11 years, we did not have a single recession. So the market went up too high, and it went up too fast as well, because you can see the last recession when it started, well, the Dow Jones was, I don't remember, approximately 12,000 points. It went to 29. Just for you to maybe to remember, so when President Trump came to the office, it was beginning of November 2016, the Dow Jones was at 18,000 points. So in a little more than 3 years, it went from 18 to 29, which is almost 60% upside. So when you look at the screen, we had almost 40% annual increase in the stock in Dow Jones from the lowest point of 2009. Obviously, it's not sustainable. This gain was not sustainable, and the market was up to recession, due the recession. But the market was looking for a trigger. And we got COVID-19, which is the mother of all triggers, obviously, and the market corrected itself. But what I want to point out is that at this point, as bad as the news are, the stock market itself, and obviously the stock market and the crash of the market is majority of economical news today. So it went down so fast. It's unbelievable. This The graphs you see, they correct as of yesterday, which is March 24. And the drop was approximately 33%. The drop in 2008, 2009 was 50%. So yes, the point-wise, we got the worst drops as of now, but percentage-wise, we had worse. One of the biggest drops was in October 1987. So just in perspective, because the stock market went up so high, 29,000 points, the drops are also big. But percentage-wise, just for you to know, they're not the biggest. Now, did we hit the bottom of the market? Nobody knows. Probably not. But it's a good indicator where we stand today. So I want to give you a couple of examples of what's happening. Before we do that, I just want to put a small disclaimer. So I want to read it to all of you. So the following slides are used for the informational purposes only, should not be viewed as suggestion of entering the stock market or real estate acquisition. Past performance does not guarantee future results. All viewers of this material should perform their own due diligence and analysis. So all I'm doing is I'm showing you some sample of what happened in the past, okay? View it as only a samples of what happened in the past. So the first example I want to show you is an example of company called Dollar Thrifty. And all of you know this company. Obviously, it's a car rental company. They operate to this day. The difference, they are not independent as they were several years ago. So the story of this company, it was trading like any other company, and they were not immune to the crash of 2008, 2009. So on March 9th of 2007, the stock was trading at $51.20. It was near all-time high. I didn't put the all-time high on purpose. I selected the March 09 because I wanted to show you the next row here as well. On March 09, 2009, exactly day to day, 2 years after, the stock dropped to 71 cents. I mean, it's brutal. Somebody who bought the stock at $51 and did not sell, went down to 71 cents, lost 70 times value of the stock. I mean, how many people can be in this position? So it's normal that most people start panicking and there's panic selling. But understand this, when there's selling, there's somebody buying, because transaction requires, two parts. So selling was fast, and on September, after March 9, the stocks, all of them started to recover. So on September 22nd, 2010, the stock closed at 51.37, returning to the pre-drop price. Meaning, if you didn't sell the stock and you held the shares without selling, you would get all your money back 18 months after the crash. But this is what's the most interesting and the most amazing story. In August 2012, the company called Hertz, which is also in car rental business, acquired Dollar Thrifty at the price of $87.50 shares. And the return on the investment, if somebody bought this stock, the shares of Dollar Thrifty at the bottom of the market on March 09, 2009, they would get 123 times return on investment. Now, just to make it, if somebody does not understand in money, how much is it? So if you would put $10,000 into that stock on March 09, 2009, look, in 3 years after, you would get $1,273,000 of value. And it's just incredible. It's retirement, right? Just 3 years. But not just that, the stock hit actually this amount, or the price share of 87, or more or less, actually in 2011. It just the company got bought out in 2012. It's just incredible. 2.5 years, you get 100 times return on investment. Now, just a sample doesn't mean it's going to happen now, but this is an example of drop and recovery, and this can happen very quickly. The following two are my own samples. I entered the real estate markets 10 years ago with my friend. It was April 2010. The real estate recovery took longer. obviously because people could not get mortgages. So we went to Florida, and this is the condo unit we purchased in Florida, in Miami, just north of Miami. And this condo was selling for $255 in 2005. We bought it for $105 in 2010, and we overpaid. Like, it was our first deal. We had no idea what we were doing. Later on, there was another small crash, and the same unit we could have probably purchased for about $70,000. But doesn't matter. We just held it, rented it out, and as of last year, I didn't update the numbers for the presentation, but as of last year, the price of the property doubled. We do get a little bit cash-on-cash return of 4%. It's cash flow positive, and the value went double. We took the money, we took our initial investment out, and we invested in other properties. So we got, on average, 12.4 return on investment just from the appreciation of the property, which is amazing, right? Plus the positive cash flow. This is the second property we bought. That was in January 2011. This property was selling at, I believe, at 205 around the 2007. We were able to buy it at $67,000 during the recession, and the property went up. At some point of time, it was almost to $200,000. Went down last year a little bit, but regardless, you can see the property appreciation was 141%, or 70.5% annual appreciation. Plus, we get cash-on-cash annual return, and we got the same tenant living in the building since 2011 for 9 years. So it was hard. We had to take money from our line of credit. We were beginning investors. We had no idea what we were doing, but we still did it, and we went against the flow of the market. So again, just to highlight, it's going to be opportunities now. We all can take advantage of what's coming next. And the last topic I wanted to cover is my advice to you to be a professional real estate investor. What does it mean? A professional real estate investor does not depend on a single location or a strategy. So taking us, for example, in 2017, it simply became impossible to do any real estate business in Ontario. The prices went up. In 2016, there was a huge drop in 2017. So we decided to leave this market altogether. And we went to Arizona, and we've done close to 10 deals since. But if things will change in Arizona, we're going to go to other location, right? And if we cannot do development project anymore, if it wouldn't make sense, we can switch. We can do buy, rent, and hold. We can do lease options. There's so many strategies we can do. So we do not depend neither or Canada or Arizona for our deals. And the second thing is that professional investors always have plan B in case of original strategy is not longer viable. So for us, if we do a development project and we expect to sell the homes once they're built, what if nobody's buying? So we can always rent them out, refinance the project, and be cash flow positive, right? Returning money to investors. Let's say you're doing Airbnb. This is your only strategy. Obviously, it's going to be a hard time to bring people into your Airbnb properties, but probably you can rent those properties out for the longer period of time. So always think of plan B. Do not depend on a single location. Do not depend on a single strategy. Okay, so this is what I've got to show you today. And to move forward, there's one more slide I wanted to show you. This is the quote that's actually from 19th century. There was a person very known at that time, actually still today, Sir John Templeton. And he said, the four more dangerous world in real estate or investing, it doesn't matter if it's stocks or real estate, this time is different, right? And every time there is a crash, people say, well, this time it's different. Well, it's not. We're going to come to the recovery. We just don't know when it's going to happen, but it will happen. What's different this time is the reason why we're going into recession, probably depression. This time it's the virus, right? We still don't know how to fight the virus. We don't know how long it's going to stay with us. But once we go over and everything is completed and we win in this situation, it's going to be a big recovery. So this is not different. Circumstances are different, but the recovery is going to come, and we're going to ride it all together. So to continue, I just wanted to bring somebody special to me, somebody special to many people on this webinar. He mentored more than 200 people, and I was one of his students 6 years ago. And to say that he impacted my life is just an understatement. I was able to implement the strategies he suggested. I was implemented to go full-time real estate, so I no longer go to work. Was able to quit my 6-digit annual income more than 3 years ago, and hopefully I will never look back. So I just suggest you put very close attention to what he's going to say. He's going to cover the ideas in more depth, the current market situation. So I'd like to bring Ronnie Bykovsky. So Ronnie, please take over.
Michael, thank you so much for very thorough and very educational presentation. All the wealth of knowledge and admire your ability to think, take, and influence.
Oh, sorry, you didn't hear me, right?
No, now we can hear you now.
Okay, so all I said, Michael, thank you very much for the thorough and educational presentation. I admire your ability to learn and share the knowledge. It's not a very common trait, so thanks so much. So let me just do the a little bit of housekeeping here. Share screen, and then I go here, and then I go there, and then I go here. Okay, I think I am almost good. Okay. Okay, perfect. Everybody sees this, right? Michael, I need you to tell me if everybody sees this slide.
Yeah, I can see that.
Perfect. Okay, fantastic. So good evening, everybody. Thank you for joining us tonight. I know it's very challenging times, and whenever they're challenging times, especially now when we're isolated and we're on our own in a way, we don't want to be on our own. We want to be in the community. We created IIC to create a community, and all of us coming tonight here is support to us and to everybody. And the idea is to share what we know and learn from you guys as well. So as Michael said, 23 days ago, we had a fantastic meeting of investors in their circle. Everybody was happy. I was just a few days before traveling to England to watch soccer game with my son, which eventually we did. It was the last match of the season in Europe. And although my team lost, they play phenomenal. This is soccer, you know. They played phenomenally. It was fun. It was great. Atmosphere was awesome. And we were all super optimistic. And the spring market was around the corner, and we thought, oh my God, the market was very tight. Remember, I spoke about tight number of properties on the market, high sales, and price increase 8 to 10%, and we were all happy. And then, you know, reality check. It's a new time. Now, as Michael said before, everybody, I'm sure all of you are listening to the news. We don't really know how it's going to go. It's different than how it was. It's new to anybody. We don't really know how to act, and we don't want to react. So all we can do is take all the information out there, whether it's about the virus itself or about economy and real estate, and just put it out there, because, you know, if you really follow the news, and I used to follow it in the first week, it's tiring. It's all bad. Wherever you go in the world, you know, it doesn't matter how many languages you speak, it's only bad news, whether it's Chinese or Spanish or Italian or Portuguese or Russian, it's all bad. So let us take the information and put it a little bit in perspective, and hopefully get some better understanding of where we stand. Well, the topic of real estate is important because realistically 50% of the world wealth is invested in real estate. And this is outside the homes that all of us own. Okay, so 50%, that's a big number. So this is too big to ignore, all this real estate sector. So we really need to pay attention. So let's jump into this beautiful kid that said, we can do it and we will do it. Okay, all of us together. I like the zest of this kid. So let's all of us do this now, and let's do it together. Okay, so let's talk about the most to least vulnerable sectors in real estate market. Some more than others. For example, the first two are a combination of real estate and businesses. hotels, venues, concert halls, bar, restaurants, all the hospitality industry. By far, this is the most vulnerable one now, and we see closures of them. Many of them turn into hospitals to contain the coronavirus patients. But this segment, nobody's going to any conference anywhere. Even if it wasn't banned, and it is banned, people wouldn't go. The second industry are the senior homes. And, I just watched on the news yesterday, a lady turned 100 and her family stood outside the senior home because nobody could go in. It's heartbreaking. And it's going to take a long time for them to feel safe to admit new people in. And, with the baby boomers, we know the shortage of senior housing as is. There's going to be a longer waiting time for new people to be admitted to places. And now with senior housing, I would also include student housing, because purposely built student housing are a unique product. And for my daughter goes to Queens, they shut down for the year, but the scarcity of real estate is so high there, so people actually start renting in October for the following school year. So the lease goes from May to May. So she already found a place, and we paid, and all good. But if you're a landlord that you didn't lease it yet, you're going to be empty for a long period of time. So those two ones are more businesses. The next one is really real estate, whether it's a Yorkdale shopping center or neighborhood plaza. Go outside and see the retail establishment. Yes, I know that Doug Ford came up with the 75 essential businesses. Funnily enough, the LCBO is one of them. That's, Canada, what can we say? But the retail establishment, restaurants, all the street plazas, really hurting badly. The other sector is office and industrial. Again, those places are literally deserted. We came to the office now to do this call from the office. Nobody's coming to the building, and we have a relatively small building, probably with 200 people at most. And we'll talk later about all the subsidies and how to help employers stay in business. But you see, industrial and office, people are scaling down. About 15 years ago, the big companies wanted to promote a work from home environment, and they really worked hard at it for many, many, many years. And I thought, or many people thought, it was successful, but apparently it was less successful as we thought. And you could see it because about 3 years ago, if you look at any city in North America, the office vacancy for the Class A office dropped dramatically, and a lot of new product came to market because all these companies saw that it's fun, it's nice, it's maybe good for the employees to work from home, but long-term for the company, it's probably didn't work as they expected, so they started leasing more and more and more office space. And of course, now it's changing. And the least impact sector is where I think most of you guys are in, is residential real estate. With all the problems, with all the layoffs, with all the high unemployment that we may see, between all this sector, I would really want to be in the residential real estate side of things. Let's talk about possible issues or probable issues that we may face in the real estate. First one is non-payment of rent. In basically all tenant classes, there's A, B, and C. This goes by neighborhood. If we look at A class, these are people who employed full-time with a lot of benefits, high-paying jobs. Majority of the populations are in the B class. There are a lot of full-time jobs. Call it in Toronto, it's probably 60, 70,000 to 100,000. This is middle class. A lot of union jobs, and they have disposable income to spend on goods, services, and other stuff. And the C-type tenant are the tenant that live in the least desirable area, and they can afford what they can afford. And once they get better to move, they move to better areas. Either they buy a place or they rent in a better place. And most of the businesses that were impacted initially, and we saw the hospitality, are C, B minus, and C class employees. all the food service industry, hotels, cleaners, retail guys, all the people in the retail. There's a lot of people that really work in those jobs for a living. Look at Starbucks. Starbucks make a career. People work there all their lives, and they're out of work. And those people usually don't have a lot of buffers and don't have a lot of savings to weather the storms. So an action item that I'm going to talk later on, but really, if you have a residential properties, you want to be in communication with your tenants and see where it goes and what the situation is, and really be on top of things. Don't wait for them to tell you that they can't pay you rent. Now, I think we can see it. B class is going to be more stable, I think. A class usually have most stability. Look at an office building. A class building would be the large law firm, accounting firm, investment grade tenants, as they're called in the industry. And you know what? They can weather 2-3 months, no problem, 4 months, maybe 5 months of paying rent. But 2008 wiped out a lot of them as well. A lot of banks, a lot of investment companies were wiped out because they lost all their investment funds. So this takes me to point number 2, the term of the crisis. We can't really know what it is, how long it's going to go for. We can assume and we can hope. Now, you can be pessimistic, you can be optimistic, you can be realistic. I think trying to be realistic is very important. I texted with a friend of mine yesterday, and he has family from Wuhan, and he said that majority of the people are almost back to full capacity now. So it was only in December, we're in March. So let's say June, let's say July. So we're looking at realistically about 6 months. Trump said few weeks. Some people say few years. I think if you give yourself, 6 months to see really where the market is going and start coming back, it's pretty realistic. Also remember that, recession, depression, all those things are created by people, not by environment, not by outside forces. People stop buying. When people are stopping to buy, nothing really happens. I remember 2008 when the subprime crisis hit, and Bear Stearns went under. It was, I think, November 21st, and Lehman Brothers followed. It was shock. People thought that was the end of the world. And for 6 months, nothing really happened. But in Canada, we didn't feel, I think we have some people from the US on the call. Nothing really happened in Canada. So things came back. 6 months later, properties in my area went up 12% in 6 months because the bottleneck came together. People waited, came back looking to buy properties. So, if people are going to understand, there's a problem, we will learn how to live with it, and we'll go back to go out to restaurants, shopping, etc., etc. This will create the economy to bounce back. Another possible issues or potential issues is closing deals, residential and commercial. See, if you're in the middle of due diligence now, we had a land under contract. I wanted another 90 days to see where the things is going. The vendor wasn't willing to give it to me. Thank you very much. I'm not continuing. I think many people that are looking to buy now will sit on the fence, rightly so. Now, but some people are committed to closing deals, next week, next month. They have deposit, they have firm deposit. Their situation might have changed. As Michael showed on the graph, the fear factor is really huge, or even panic. So what, I'm going to buy a house now when the world is falling apart? So deals may not close. Maybe people will walk away from deposits. I think that even firm deals can see buyers, and definitely more on the commercial side. If you're buying commercial properties, you're trying to renegotiate the deal. You're going back to the seller, and you're trying to, to get the discount, to get abatement, to get something. Because if the market will go down, you say, I don't want to pay the top of the market, because we know whoever's buying properties now, 3 cap, 4 cap, that's expensive. And I think there's going to be some negotiation in that marketplace. Unemployment, well, that's the biggest unknown. People talk about doubling, tripling. Well, we were in very good situation. As February, it was 5.4% throughout the country. Between 5 to 6% is very good unemployment rate. 2020 should have been like in the 5.5, 5.2, 5.3. It's up and down seasonally. And we saw there's additional 500,000 people that are looking for EI. And what it does to the unemployment rate, and I just read just now before the webinar, I think RBC said that the highest that they think it will go is 7.7% unemployment rate. And again, this is seasonal. This is just now in the next 4 months, without really looking long term. Just in perspective, in the US, the subprime crisis, the unemployment was 4.5%, went up to 8.5%. And it was a big boom. Now we're talking from 5 point something to 7 point something. Yes, it's 50% more, but it's not a killer. And again, a lot of those businesses, some will go out of business. We know some bankruptcies because not everybody's gonna come back. But some of them will open the doors and will employ all those people who were laid off now and will be laid off in the next little while. Last factor, of course, for us as real estate investors is the vacancy rate. What will it do to the vacancy rate? So it really depends, because I'm going to talk later about the measures about how to keep your tenants. But there, the number of people in Canada is not decreasing. People still, and I'm talking about residential per se now, people still need a place to live. And if they move out elsewhere. And the GTA is anyway about 1% vacancy rate. And actually anywhere in Ontario is a 1 to 2% vacancy rate. So where will they go? They will have to find either way to pay, or the government will have to step in and pay rent. So I think on the residential side, we're not going to see a lot of vacancy. We may see vacancy in the expensive properties where people will adjust. But overall, I don't think it's going to be a catastrophe. Commercial, it's different. If you're closing a store, you're closing office, takes a lot longer because you close an office because somebody went bankrupt, right? They couldn't open the business. So how soon will somebody open a business that will be able to occupy exactly that space? It may take a little while. Next thing, let's about action that is being taken. And I think the most important thing that governments all over the world, and I'm talking North America now because most of the people here are from Canada and the US, they jumped in really to take advantage, take immediate action. Canadian government announced $82 billion, and they know it's just phase one. It's going to be a lot more because we're going to talk later what the US offered, but they immediately said, we're going to help subsidize wages because we don't want you, employer, to lay off people, because they know if the business is shutting down, right? You didn't get rid of the employer. Maybe you got rid of as an employer. You don't have to pay the employee, but the employee will come back and ask the government for money. So either they pay now, the employer to keep in a business, or pay later. Availability program. That's a new program of Business Development Bank and Export Development Canada, that they immediately put a $10 billion fund to keep business going. This is triple the fund that they have on a regular basis. So all those companies that said, let's go export, let's expand, yes, continue doing it, there's money in the system. Liquidation or liquidity in the financial market is key in these times. So what they did, they lowered the bank buffer. Basically what it allowed for another $300 billion to be available for lending to the commercial market. Now, this is not mortgages, this is businesses. So all the businesses that are now out of business, they don't have income, they have access to cash to stay afloat. Now, this is not a 5-year loan that big business will take, $20 million just to stay afloat. But, if you're looking at 6 months, right, at low interest rate, it will keep everybody afloat to see really where this thing is going. And I think it's going to a place where a solution will be found pretty quickly. The government buys insured mortgage, opened another $30 billion for mortgage lending. Again, people that need to buy, continue buying. Of course, they're going to be bailout on other mortgages, and they're going to negotiate with people that defaulted on the mortgage. that's a separate thing. But they immediately liquidated the market, so the banks can continue working, people can continue consuming and buying real estate. They cut interest rate, March 3rd to March 15th by 100 bips, which is 1% basically. 50 basis points and another 50 basis points. Immediately, let's lower interest rate. That's what happened in 2008 and really helped the fast recovery. And of course, CRA, our partners in the government, postponed payment till September, actually till August 31st. All the tax owed from 2019, there's a grace. HST, there's a grace. So they're saying, okay, we understand there's a problem. Let's put it on hold. Let's continue to provide finance for the economy. And this is very important. And on the big thing, it's happening on the US as well, right? The stimulus package is $2 trillion, just announced yesterday. That it's the biggest ever in the US history. This allows for $500 billion to go immediately for business financing, loans, lines of credit, another $400 billion to assist employer payroll. They said, we're going to pay 80% of the employer's salary for 3 months now. So keep people, don't lay them off. Let's wait. That's why Trump said, let's open by April 12th. We want everything going again. So realistically, probably too soon, but within 3, 4, 5 months, they really hope that very few people will really lose their jobs and majority will keep on working. They even gonna pay $1,200 for each person in the country, and each kid until 17 years old gonna get $500. Many times stimulus is like reduction of taxes and this is here, take money. And you know, what does it do? I think it creates, as we said, a psychological space where people say, oh my God, I have a big brother. You know, whether if Trump is good or not, it doesn't matter. You know, somebody cares about me, I have money, I'm not thrown out in the street, things gonna be okay. And again, this getting out of panic mode is, I think, where the government can do most work. Now, let's talk about what we can do from our standpoint, because the government is good, but different people, especially investors or different trades, have to come together and see how to stop the bleeding and maybe influence things. So a restaurant Canada, he said, let's put a ban on eviction and property seizure until solutions are developed to ease rent obligation for business impact by COVID-19. It's an outside problem. It's not like a failed restaurant, although, you know, that's a lot of other things. You know, how many businesses will take advantage of this to really shut their doors down and maybe not pay severance to their employees. That's a whole different conversation. But majority of the good businesses will hurt. So they're getting together and say, hey, let's think together. And basically what they're telling the government, say, you know what, we need you to come later on and help us. Prudent landlord, for example, almost 33% of Canadian households rent their homes. Who is going to help them in coronavirus crisis? Well, Doug Ford just said on March 20th, how did he say it? He said, no person who cannot afford to pay the rent due to financial concerns amid the COVID-19 pandemic will be evicted. Okay, boom, that's just 5 days ago. Now, is it good? Is it bad? It's kind of bad for landlord because saying, listen, I can't evict my people, all right? People who do not pay me. But you know, as a landlord, if they're not paying you, you're going to bring a new tenant that probably won't be able to pay you as well. I think renegotiating with your tenants is very important. And I think in the next webinar, we'll really talk about some property management fundamentals this crucial time. But basically, if he says that, he knows that the property owners are hurting. Now, they know that not all property owners are wealthy, filthy rich, and they don't care about anybody, just want to make the money. Because of the high leverage, because of the price of properties, most properties are on the verge, can't afford, you know, too many non-paying tenants because they will be upside down on the mortgage. So I believe that, you know, phase 2 of the $82 billion subsidy from the government will come to ease off landlord mortgages and stuff like that. Another thing is what the big boys are thinking. You know, Brookfield one is the largest real estate owner all over the world. They have real estate, they have non-real estate, they have ports, they have just name it. But the COO looks at it as the meltdown is manageable. And what he says is that the biggest crisis that they had, it's not even 2008. He said this is kind of a little bit similar to what happened after 9/11. Because everybody knew what the source was of 2008 crisis, and most time it was because of the high-tech bubble, and then the mortgage scam, and all those things. And this came from an outside source that nobody could foresee. 9/11 was a shocker, and it took them about 8 years to figure out how to continue. And said this is similar because we didn't prepare for that. But it's manageable because we have checks and balances, and most of their employees are Class A tenants, and they, of course, he's telling that, you know, to ease off his investors and not panic. But you know, between the huge real estate owners and the government, there's a lot of understanding that things must remain. And you know, back in the day, there was a sentence, "Too big to fail." After 2008, we know. Nothing is too big to fail because huge dinosaurs failed. But I think we're in a different situation right now, and people have plans. And the last thing is more landlords are deferring rent for hardest hit tenants. And there's a company called First Capital. They just branded themselves as a REIT. There was First Capital Realty, now it's First Capital REIT. And they're commercial landlords. Very good, their occupancy is very high. Immediately, they put the $30 million fund aside. Now, they can afford it, but think about it. They put $30 million that we're going to help our small tenants survive. We don't want them moving away because they can't pay rent. So we need to really think about that and how to do the same thing for ourselves. So if you're an owner, maybe you don't have $30 million, but maybe you have a few $1,000s aside. Later on, we're going to talk about how to look for the money to put aside to really help keep your tenants. You're doing two things by doing that. A, if they move out, finding a new tenant in bad times is not easy. Secondly, you're the good guy. You're helping out. You're not being mean. You understand that, you know, it doesn't matter. Some people take advantage, and some people, if they don't get what they want, just get upset at other people, and people who cannot pay rent are bad people. Okay, I know a lot of landlords. You guys, some of you are like that, but some of you are saying, you know, we're all in the same boat. Let's not sink the boat. Let's work together. So doing rate abandonment on a case-by-case basis, you know, postponing the payments. Like the banks will do with mortgages. They already said that they will spread the mortgages, unpaid mortgages up to 6 months, no problem. Okay, they let people time to recover. Next thing, let's talk about opportunities, because in every bad there's good, and it's not taking advantage, just helping out. First, we talk about closings. What's happening with closing is that people are, again, as I said in the beginning, some people will need to close their properties next week, next month. They can't. What do? Well, they may have deposits. You can come in, you know, I always look partnering up with people or providing people with short-term financing, maybe at a higher interest rate, but at least save them from losing deposits. You'll see a lot of residential and commercial for the sake that, you know, some people just lost their jobs. What can you do? I mean, they, you know, they're employed now. In June, when they come to close, they're not employed. They can't get a mortgage. So, you know, can you jump on a mortgage and get, you know, 10, 15, 20% equity and save the day? Commercial deals are larger. And as I said before, many times it's going to happen where commercial deals will be renegotiated. Maybe some people will walk away. Maybe some lenders would pull out. You know, when you buy a house, you know, TD is not going to bail on you in the last day. It may happen, but it's rare. In commercial deals, you know, although they sign the commitment and the commitment is that a lender has the right to pull out at any moment for no real reason. I remember I had an incident once, and we were away on vacation, and my family came from overseas, and a week before closing on 2 apartment buildings in Edmonton. In retrospect, I knew why. The lender was it wasn't a private, it was semi-institutional. Got a call, spoke to a friend in Edmonton, and said, oh, the market's too high, I don't know if you should do it. And he said, okay, I'm pulling out. So my vacation was ruined. I was running around like crazy to find another lender to close the deal. I ended up closing, it was okay. But I think you're going to see a lot of commercial deals not closing now, because lender also don't know. We think we don't know what's happening. If you're managing $100 million and you have to lend it on mortgages, you want to make sure that you're lending on something that's safe and secure. So hotels, restaurants, all those businesses, even senior homes, student housing, maybe there's going to be a lot of deals falling apart now. Apartment building. Well, apartment building. I have a friend who wanted to buy an apartment in a Class C area and reposition it and bring new tenants. And I told him, just make sure that your first mortgage will not pull out, because he may buy it, start renovating, and he's not going to get the money that he thinks that he will get, and it will take him a lot longer to rent. Now, quite a few apartment buildings were built in recent years. And some of them are 40, 50, 60 units. If you're now coming to a term that you have occupancy permit and you want to start listing it, and you thought, great, I'm starting the spring market. Well, guess what? Probably not going to be very easy to absorb those units. Maybe it's going to take 6 months or 9 months or even a year to list what you think will take you 3 months. And again, as I said, we are always looking for a way to partner up with people. So maybe, if you have the ability to look at those opportunities and come and, just buy, maybe the owners don't have the buying power, the staying power to list it over 9 months, and they have to put conventional financing on it, and they need bridge financing. So there's a lot of opportunities in this place. Land. A lot of land deals take a long time. You buy land, you go through rezoning, site plan, sometimes official plan amendment, all those things to be able to start buying. Everybody knows the inventory is low. Everybody thought the market will go up. Now there's uncertainty. I don't see a lot of people jumping into starting construction tomorrow or next week. Sometimes land, or many times, has financing on it, right? I thought I'm going to start construction in June. Well, guess what? I have to pay a mortgage in June. I don't see a lot of lenders standing out there willing to lend on mortgages on land because of the uncertainty. So again, some opportunity to come in with interim financing, excuse me, and stretch the project to allow the market to stabilize itself and maybe start construction in October or even next spring. Private lending, well, it's true for apartment building, residential, commercial land, but also for regular guys. A lot of you are already investors in mortgages, and you know that it has a term, and the term is due. And what if people cannot? Recycling debt is basically how the world works. If you look at the bond market, that's what it is, right? Somebody issues you bond with 5-year term, and in 5 years they're not going to pay you the principal from profits. They're going to recycle the debt and issue new bonds. If the private mortgage coming to due date is coming now in April, I don't see a lot of people jumping behind and willing to get into this mortgage because the uncertainty. The last thing is actually two things is education and preparation. Well, it's very difficult to really learn new things now because people are in panic. I see myself, it's like a lot of thinking. So learn something totally new, hard. I'm trying to take a few courses now, but it's not really registering. But what I'm finding myself doing is doing what I'm doing better, getting more into that. And I think in our world, you can find a lot of skills. And I said many times, you need skills, you need deals, you need money, you need to put all of them together. But don't learn skills now. Don't learn how to be a plumber or a builder or anything like that. But look at the market opportunities and say, okay, let's say everything gets to normal within 5 months, 6 months. Where do I want to be and what skills I need in order to be good, to be the best? And we need sales and marketing and the ability to understand financing and capital raising. You have to look at two things, sales and marketing and capital raising. I think we spoke a few days ago with Michael, and we may do a bootcamp of a capital raise because everybody has the same thing. It's not the idea is to go, hey, give me money. It's how to do it, how to basically structure a deal that it's fair to everybody. That's the key of this thing. So educate yourself to get better in those specific areas and be prepared to take action once everything is calm again. And liquidity. Liquidity is something that you always want to have, and I think this is time to go get lines of credit and stuff like that ready and available, so when the opportunity comes, you can jump on it. Now, some of you are employed or whatever, you may lose your job, I don't know, but as long as you're employed, go get your financing in order, be ready. Sometimes you would need the money only for example, your investment property. Suddenly, you have a fourplex and 2 units are empty now, so help carry the load so you don't have negative cash flow. You take it from a low-cost line of credit. So I think you have to do a lot of work in that segment. Q&A. So there's a few questions that were asked. I'm going to answer them. If we have more time, we'll have some more. The first one was, I completed renovation on a marvelous fixer-upper. Should I sell now? Well, part of the 76 essential jobs that Doug Ford agreed are actually everybody that has to do with real estate. Builder, renovators, construction guys, lawyers, appraisals, realtors. But another thing that they said, and Toronto Real Estate Board said, no open houses, no showings, I think. So, let's say even if the market was good, who's going to come see the house? And if it's your house that you live in, is the person that came sick or not? I think we're going to see open houses with masks moving forward and gloves. This is going to be the norm. But for now, I think the market is in such a place that I wouldn't do it, because all you're going to get is probably a lowball offer, because people are not desperate and they don't have to buy a house to live in it. That's at least what I think. So I would just wait at least 2-3 weeks, see where the wind is blowing. Another thing is, a very interesting question is, can I get out of my commercial lease? Because a lot of businesses have long-term leases with personal guarantees. I have a lease on my office. If I want to get out, if my circumstance change, usually I can't. I'm committed. Well, in every lease, every commercial lease, there's something called force majeure. And this is a very important legal question. And actually, I had a conversation with a lawyer this morning exactly about that. Somebody specialized in commercial leasing. And he said, first, the lease itself, the way it's written between you and the landlord is really, you have to look at it and see how things are written there. But even if they go to the Supreme Court of Canada, will they interpret it, this COVID-19 season as, a force majeure? And when you go to court, you never know. There's a good chance, yes. But if you are, you definitely need to find a good commercial lawyer and let them look at your lease and give you an advice. Another question is, interest rate went down. Should I refinance my mortgage? Well, funny enough, although the reason interest rate went down, as I told you, by the whole full percentage point, there are two types of mortgages. There's variable and they're fixed, and because the fixed mortgage is really determined by the long-term interest rate, which is the 10-year government bond. What had happened, because in Canada and the US, the government said, we're going to free everything, we're going to buy everything, right? The bond became a good investment, so the yield on the bond went up. So the fixed rate actually went up, although the interest rate went down. That's funny, but that's how it is. Now, up to 2 years ago, the variable rate was much lower over time and always won if you compare it to the fixed rate. That's not the case. The variable rate today is higher than the fixed rate. So although the interest rate went down, the variable rate doesn't really justify it. So I think refinancing totally just for the interest rate, maybe no. Maybe if you're afraid for your financial ability, if you have an investment property, and maybe you can re-amortize the loan, I would maybe look at something like that. Maybe if you have a 25-year and you can redo a 25-year and lower your cost, I think this is where you should be looking at. So before we conclude, and if you have any questions, we'll look at them later. We really need to stay positive, stay fighting in a good way, with good spirit. Be strong, be brave, be ambitious, be focused, stay strong, and more than anything, stay social. You know, it's like it's a different social world now. We're all one community. Let's help each other, and let's get ourselves better than we were, more compassionate, much smarter investors, and let's continue prosper together. I really want you to stay informed, and we will in the next few days. We'll set a date of future webinars, so we can all get together and share the ideas. If any of you have any questions, many of you already know us, but this is info. Here, there's the email. You can send an email if you have any topics you want to discuss. If you want to present, if one of you are a fantastic presenter that can provide us with a lot of value add, please come and present in one of our future webinars. So thank you very much. I will open it for any kind of questions if people have.
Well, we actually have two more questions. Do you want to address now? Because I just typed people to send the questions to us, and we'll do it next time. We went over time. We said 45 minutes, and it's over an hour. So I guess we'll do additional questions next time. We'll it went over an hour, so.
Okay. So Michael, thank you very much for your efficient webinar skills. As always, very resilient. And guys, let's look forward to a very bright future, and let's stay in touch, and let's build a strong community.
Absolutely.
Perfect
Thank
evening.
you so much, everyone. So we're here to help, to share the knowledge. You got our contact information, so don't be shy. Contact us. We'll do our best to help out with advice, answers, anything else we can do for you. Thank you so much. Stay healthy, and until the next time.